Welcome to our channel. Life insurance can be a powerful estate planning tool, offering tax advantages and wealth transfer strategies. Follow these step-by-step instructions for effective insurance-based estate planning. Step 1. Understand that life insurance death benefits are generally income tax-free to beneficiaries, making them efficient wealth transfer vehicles compared to other assets. Step 2. Be aware that life insurance proceeds are included in your taxable estate if you own the policy at death. For large estates, this can trigger estate taxes. Step 3. Consider an irrevocable life insurance trust to remove policy proceeds from your taxable estate. The trust owns the policy, and proceeds pass to beneficiaries estate tax-free. Step 4. Use life insurance to provide liquidity for estate taxes, ensuring heirs don't need to sell illiquid assets like businesses or real estate to pay taxes. Step 5. Implement wealth replacement strategies where you gift assets to charity during life and purchase life insurance to replace the value for heirs, gaining charitable deductions. Step 6. Consider second-to-die life insurance policies covering 2 lives and paying at the second death. These cost less than individual policies and efficiently transfer wealth to heirs. Step 7. Review beneficiary designations regularly to ensure they align with your estate plan. Life insurance passes outside probate directly to named beneficiaries. Step 8. Consult with an estate planning attorney and tax advisor before implementing complex strategies. Insurance-based estate planning requires coordination with overall estate documents and tax considerations. Don't forget to like this video and subscribe to our channel.